Right, and we have attendees. Welcome everyone. I can see Frikkie is in the room, and Willy and Vijesh, and lots of people are streaming in. Great to see you. Please hop over to the chat area. If you've been to one of our webinars before, you know that at the bottom it says there's a to field and it says all panelists. Please, if you can, change that to all panelists and attendees. So all your colleagues can also see your the questions you're going to ask, and please use the chat as well to introduce yourself. I've got a cool list of participants that are streaming in, but not everyone can see you. Hi Georgina, good to see you as well. Georgina is a colleague of mine, so it's actually her job to kick things off in the chat. But it'll be great if everyone can introduce themselves, and then in a minute or so, we just allow for a couple more people to join as people stream in. And our experience is that people will still keep streaming in over the next 10 minutes or so. But we're not going to wait for that because we've got lots to get through, and there'll be a recording. So I actually can't wait to get into things. As you can see behind everyone, LIBOR is the topic, and I think you've come to the right webinar if you want to know more about that. I'm going to stop sharing, and I'm going to officially do the official intro. So today we're going to talk about LIBOR, everything finance teams should know about alternative reference rates. As you may or may not know, and hopefully you do, at the end of this year, a significant number of London interbank offered rates, LIBOR, the benchmarks go on official retirement and are replaced by alternative reference rates. Finance teams and treasury specialists, and I'm sure we'll have some of them today here, are in for a wild ride, and you do need to get up to speed with those changes very quickly. And I can promise you that at 12 o'clock today, you'll be a lot wiser. So a very warm welcome again to this webinar, made possible to you by our brand new Finance and Urban Network partner, Absa CIB. We're really grateful to have them on board and have them support the community. So my name is Joel Roerig, and I'm the Managing Director of CFO South Africa. I indicated it previously, but please go to the chat and say hi, let us know where you work. Make sure you select all attendees and panelists so we can all see where you work, and can all see your questions as well. And please don't be shy with your questions. We've got some 3 absolute experts on our webinar today. They've made themselves available for you today. So all the questions, there's no bad ones, I almost want to say. Everything about LIBOR, bring it on. I'm just going to introduce the panelists to you before I hand over. So we've got Perrine Kogaldas, Head of Treasury at Absa Group, and he'll give us a market update with the latest around LIBOR. We've got Michelle Knowles, Head of Trade Finance Product Management at Absa Corporate and Investment Bank. And she will look into the implication for trade finance specifically, and also the transition with the trade finance angle. So we're going to start with Annelies Snijman. She's the Group Head of Financial Resource Management and Regulatory Strategy. And Annelies will introduce the topic and explain the essentials of the transition away from LIBOR. So one more time, I'll really encourage you to use the chat and put questions in. At the end, we'll have a Q&A session. So we're going to save up all those questions as they fly in and discuss it with the panelists in the last 15 minutes or so. So with having said that, I'm going to hand over to Annelies, and you can share your presentation as well.
Thanks, Joel, and morning, everyone. As Joel mentioned, I'll just give a brief overview around benchmark reform and where it's coming from. Just waiting a few seconds for the presentation to come up. And we're going to start on the first slide and really ask the obvious question here around why is benchmark reform a priority on the next slide. And really, maybe if we just zone in on USD LIBOR, then what we find right now is that's actually based predominantly on expert judgment, as the volume in the market that underpins LIBOR has really dwindled over recent years. This is due to a number of reasons. One of those reasons being, for example, the introduction of liquidity regulation in the banking industry, But given that this is the backdrop, what you can see, it really opens the rate up to conduct risk. And if you contrast that against the fact that currently around 350 USD trillion of outstanding notionals is actually pinned to USD LIBOR, you can see why regulators are really forcing this transition and trying to find alternatives. In the case of USD LIBOR, as you can see on the screen, it's going to be the secured overnight financing rate, or SOFR, where these rates are actually underpinned by deep markets, therefore setting these benchmarks on transactions and making them much more credible, much more resilient to any manipulation. If we then maybe step onto the next slide and just look at what are the alternatives then that will be available for the rates we currently use in terms of LIBOR. So most countries have been working towards finding alternatives. These are being set in terms of risk-free rates mostly, and that's quite important when we get to it a little bit later to see what's the difference between the current rates and the new rates. So in terms of the major currencies, as you can see there on the screen, what we've got for USD LIBOR, that the rate proposed there as a replacement is, as I mentioned, SOFR. For GBP LIBOR, it's the sterling overnight index average. And for Euro LIBOR, it's the Euro short-term rate as the recommended alternative. So I think if we then maybe just step on to the next slide before we go into how these new rates work and what the differences are, and just consider what we're observing around how the transition to these new rates are happening in different jurisdictions. We're really observing two trends across the globe. The first one is what we call this hard transition, where really the regulators in those jurisdictions have come out and said, this is the new rate. The existing rate will cease to exist on this day and date, and from then on will be replaced by this single rate. That's the case in the US and the UK, as I mentioned, SOFR and SONIA being the replacements there. Important though to note that, the development of those markets and the equivalent rates that we're used to today in terms of tenor is quite important, and we'll talk about that in a bit. The other one is this dual rate regime that we're seeing in the likes of Japan, Canada, Australia, and Switzerland, where what the regulators they are focusing on is, in the first instance, actually strengthening existing benchmarks by adding more consideration for transactions, etc., to underpin these rates. And in parallel then developing a new alternative or overnight risk-free rate to replace. Therefore, you've got this regime where you'll have two rates, and they're not necessarily setting firm timelines, as we've seen is the case with USD and GBP LIBOR. So I guess, the obvious question now on the next slide is, how does SOFR work as the new rate? Maybe just taking a step back and looking at LIBOR. So what we currently have today for LIBOR is set for different tenors, overnight, 3 months being the obvious one and most used rate. In contrast to this, SOFR is an overnight rate. And term rates, in other words, a 3-month SOFR equivalent to a 3-month LIBOR USD rate, is potentially only available around Q3 this year. So quite late, and still there's a need to develop. So in order to get an equivalent for that, you're going to have to compound your daily SOFR rate, and it will be compounded in arrears, in order to obtain that term equivalent if you want to switch out to an equivalent SOFR contract from. I think the other important factor here around SOFR is it's risk-free, as opposed to actually including that bank credit adjustment that you currently see being the case of LIBOR. So really two main differences here that need to happen if you want to switch out from a LIBOR contract to an equivalent SOFR contract. It's the term element of it, as well as the risk-free versus the credit element you find in LIBOR. And we've illustrated that on the next slide. And as you can see, the red line being the 3 months compounded SOFR. In other words, that reflects an equivalent 3-month rate to the orange line, which is the 3-month USD LIBOR line. And you can see that line's still below because of the bank credit component. So in order to make that credit adjustment for 3 months, it's a 26 basis point long run average adjustment that will be required to bring these two rates back into line. So what's the timelines around these transition and what should you be concerned with around that? And we highlight this on the next slide. So there's a number of things that we know, and we also know a lot more than what we did beginning of this year, but there's still a few unknowns. I'm not going to run through all the detail on the slide and just maybe focus on a few things. So I think the first thing to focus on is in April, we did see the issuance of SONIA rates starting to come through. In June, around this time, we were actually expecting to start to see the equivalent SOFR term rates also to come through. In other words, 3-month SOFR, etc. That hasn't happened, and that's been kicked out again, as I mentioned, potentially Q3 or later this year. But the most important dates really on the slide is the cessation dates. And for GBP, Euro, and the like, and for USD LIBOR in 1 week and 2 months, that date is the end of this year, so the 31st of December this year. And for either USD LIBOR rates, so overnight, 1 month, 3 month, etc., that date actually got postponed at the beginning of this year or end of last year to July 2023. And really that postponement was only to assist with these legacy contracts that are quite difficult to actually transition with this hard transition approach that we see being followed in the US. The regulators did try to see if they can find a legislative solution to that. It wasn't possible. And in the end, they conceded and kicked it out. But really, the aim here isn't to increase the number of contracts referencing these rates over time, but rather to allow the existing contracts to roll off and mature. So hopefully that gives the backdrop of what this transition is and the change that's happening and the differences between the rates that we're facing. I guess the next natural question to ask now is, well, what does this mean for you and what can you do about this? So there are a number of things to think about here simultaneously, probably. And the first and foremost one is to highlight a few here is around legal. And what do you do around your contracts that are currently referencing these rates, but will only mature post the cessation of these rates? So repapering them, how do you think about fallback language and the like? The second important thing that I'd highlight here is around system and model changes. As I highlighted, there is a big difference in terms of going from a 3-month rate to an overnight rate. And the certainty, for example, that gives you around your cash flow calculations and the like, your deal booking system and how that needs to change to accommodate these new rates. There's questions around hedge accounting and how that will work and what's the effects of this on your hedge accounting as well as tax. As I mentioned, in terms of cash management, this is probably one of the key ones as well. around, today if you use 3 months USD LIBOR, you've got certainty for 3 months over that cash flow. Once you flick to an overnight rate, that cash flow certainty only becomes available much later, depending on the certain agreements put in place around that. And I think the other one that we always highlight to our clients, certainly when we engage with them, is around, if you're multi-banked, how do you think about approaching that? Because not everybody is approaching this always at the same speed. So probably important to just keep that in the back of your mind as well. Before we go on, like I mentioned, legal, one of the key questions here, and on the next slide, just quickly thinking about that legal question and what you do with contracts that mature beyond 2021. So I guess first and foremost, you can embed fallback language, and what this language really aims to do is to allow for a smoother transition to one of the alternative rates that are available should the cessation happen. And the other one there is really around, you can actually also completely change that contract. So for example, in the case of USD LIBOR, to instead reference SOFR as opposed to relying on fallback language. Early redemption of your contract or refinancing that in that instance is always an option. And the final option that could be quite easy as well is actually to switch that out into a fixed rate, where you've got certainty around a number of the outstanding aspects, as I've mentioned. So I hope this gives you an overview of the backdrop of the change we're facing here in the industry, and some of the things to maybe start thinking about as these deadlines approach. I'll hand over now to Paring to take us through what's some of the latest market updates that have happened.
Thank you very much, Annelies, for that comprehensive update. Hi, everyone. Thanks for the opportunity to speak to you today. So I'm going to give a few slides and updates on what is happening currently in the marketplace. If we could go to the first slide, please. So I think, as Annelies concluded, the legal perspective is really critical here. This is where there's a lot of work that needs to happen. And I think in the last 6 months, the marketplace has really gotten to a place of comfort in terms of what are industry bodies saying. Is it articulate and is it consistent across the different industry bodies, which wasn't the case when we entered into 2021. So legal preparation is absolutely critical. What is really good about where we find ourselves now is that there's alignment. We've got the Loan Market Association speaking about changes that are congruent with what ISDA is saying in the derivative market space. And that's really important for us. It is critical to highlight, as Annelies pointed out, that most legacy contracts don't have any fallback language. That means that, if they aren't repapered, i.e. if we don't start to talk about what happens in those contracts legally when LIBOR disappears, we potentially faced with a problem. And that is this notion of repapering existing financial market contracts. When thinking about new contracts, it's also important to think across 2 dimensions. The first is, if I'm doing a LIBOR-linked transaction today, I need to make sure that that has fallback language as well. And that's certainly becoming an emerging theme in terms of financial markets activity into 2021. Alternatively, where preparedness is in place, it's very important for all of us as financial market participants to start to recognize the need to move. And when I speak a little bit later of what regulators are saying, you'll see that they are really starting to drive pressure into markets and financial market participants to ensure that that is indeed the case and that is indeed the behavior that we are seeing in the marketplace. So it is important to reference alternative rates in new contracts. And that will be a growing theme as we get into the back end of this year. So let's have a look at what the Loan Market Association has been doing. At the beginning of March, the Financial Conduct Authority effectively made a whole bunch of announcements where they said that LIBOR cessation will take place, and they articulated the timelines that Annelies mentioned a little bit earlier. Now, what that does is it triggers what's called switch events in legal contracts, which means these switch events trigger, and effectively they then dictate what will happen when these LIBORs actually cede. So for instance, for sterling LIBOR, what happens come 1 Jan 2022, and then for legacy dollar LIBOR contracts, what happens beyond the middle of 2023. The LMA has also done two things. They've recommended their final form language for existing contracts that need to incorporate fallback language. And they've also put in place a whole bunch of recommended contractual arrangements for contracts that start off referencing new alternative reference rates like SOFR and like SONIA. Most importantly, the LMA have also aligned with the ISDA methodology around fallbacks, which was something that a lot of us were worried about in the past. Lack of alignment there means that if one had a derivative hedging a loan, there may have been some financial inconsistencies, but it's great to see that that alignment has now come through. And that is important because it ensures loans and derivatives will transition in the same manner. If we can move to the next slide, please. So what has ISDA done? Now, just a little bit of background around ISDA. ISDA effectively dictates the legal relationship between counterparts that sign up to ISDA. And that dictates legally, how derivatives are contracted and what happens in certain eventualities. What ISDA has done is they've introduced two concepts. They've introduced their benchmark supplement, which effectively means that all ISDA counterparts from the 25th of Jan 2021 will now automatically benefit from the incorporation of fallback language. So that deals with new activity. They've also launched a fallbacks protocol where counterparts are meant to go to ISDA and actually formally say, I adhere to this fallbacks protocol. And what that means is it takes all the legacy derivatives along into this journey around fallbacks. Now, why is that critical? Derivatives, we know, probably represent more than 85 to 90% of overall financial market exposures that reference LIBORs. So this was a big step in actually reducing the burden around legal repapering. I must point out here that most corporate clients don't sign up to ISDA, which means that there's still a repapering effort that is required here. But ISDA has effectively set in motion the environment or ecosystem that informs that bilateral negotiation. So, I think when you look at the overall market environment, loans, derivatives, we have now sufficient conditions to move forward with confidence around incorporating fallbacks. If we can turn to the next slide, this just gives a high-level overview of the current reference rates that are out there in the market. So we've spoken a lot about SOFR. In the last 3 to 6 months, we've seen the emergence of a Bloomberg alternative called BSBY. We've also seen another emerge in the United States called the Maribor. Now, what's different between these rates? SOFR, as Annelies pointed out, is a risk-free rate. These other alternatives are effectively very similar to LIBOR, but they're actually benchmarked by underlying transactions. Now, if you look at the volumes on this slide, you can see these alternative credit reference rates have far lower volumes. A Maribor at only 2 billion versus SOFR at 1 trillion doesn't really generate the sense of confidence when we think back to the number that Annelies quoted, 350 trillion of financial market contracts that are ultimately driven by the behavior of these rates. So where we stand today is regulators are still very much backing SOFR and risk-free alternatives and really trying to dilute the market's focus in terms of adopting these alternative rates. And the reason for that motive is during times of stress, these alternatives don't perform. They aren't resilient, and they often either dry up in terms of liquidity or they dry up in terms of liquidity, or they dislocate quite dramatically, as we saw in the global financial crisis, where LIBOR skyrocketed while the Federal Reserve was effectively trying to provide monetary policy easing into the system. So the conclusion here is SOFR drives the greatest credibility and prospect of resilience during times of stress. Derivative markets are really important for the emergence of alternative term reference rates. So what exists today? We've got SONIA overnight, we've got SOFR overnight, lots of credibility around underlying market activity. SONIA benefits from a fairly deep derivative market, and hence we've already seen the emergence of term SONIA, which is starting to mature within financial markets. So that's a box ticked, particularly for products that have to reference term rates. If we look at SOFR, on the other hand, derivative market volumes are still fairly tepid, less than 10% of overall market activity, but there are a number of initiatives that are going to come off the ground within the next few months that are likely to drive a lot more price formulation in the derivative market, which means we're likely to see the emergence of term SOFR. So that's something that's really critical to look out for. If we can move to the next slide. So I just want to provide everyone, I'm not going to read through each of these individual comments, but as one can see, these are comments from a number of official sector bodies. And I think they draw some really credible conclusions. Regulators are being really clear about their message as things stand. We are definitely on a firm path towards the discontinuation of IBORs, and we have timelines in place, as Annelies mentioned earlier. SOFR and SONIA must come front and center of the derivative markets, and other alternatives are likely to emerge in the form of term SOFR as well as term SONIA. So the message that regulators are putting into the market is abundantly clear. IBORs will end and risk-free alternatives will drive their replacement. I want to conclude on the next slide, please. Just effectively summarize the key takeaways from today. Non-dollar LIBORs, and this excludes South African Rand, I just want to be clear, will transition by the end of this year. First and foremost, these need to be replaced by overnight risk-free alternatives such as SOFR and SONIA. Legals must be repapered to ensure that each financial market participant protects its transactional exposures. And remember the important point that old financial market contracts don't necessarily have fallback language. We expect term reference rates to emerge within the next few months, but hopefully by the end of Q3. And new contracts, wherever possible, it is important for all of us as financial market participants to think about the adoption of new risk-free rates in the first instance. I'm happy to conclude there and hand over to my colleague, Michelle. Thank you, everyone.
Great. Thank you, Annelies and Perrin, for the insight into the need and approach being taken for the interest rate benchmark reform, and importantly, how the market is preparing for the transition. It's off this basis that I'm going to turn our focus to the impact of this for the short-term products, specifically trade finance, and the response that we've seen in the market and industry relating to this. So as we've heard in the previous presentations, the change from the London Interbank Offer Rate, or LIBOR, which is deemed the world's most important number, to these risk-free rates, which are compounded in arrears, is one of the most important changes for the financial markets this century, from a legal, commercial, as well as a regulatory perspective. The transition away from LIBOR, especially dollar LIBOR, has a deep impact across a large number of financial markets, but the impact on trade finance is different in certain respects. And this is because trade finance products display different terms as well as different payment patterns to other corporate banking products. Trade finance exposures are diverse in nature, but they're usually short tenor, so less than a year, typically 180 days or less, and they're self-liquidating. Trade finance compromises of the working capital as well as risk mitigating solutions, and these are used by SMEs, corporates, banks, as well as government agencies. And of course, the transactions take place across multiple geographies. So why has there been so much discussion in the past year around the impact of the benchmark reform for the trade finance markets? Access to trade finance is critical to support global trade, which we know is a key enabler to economic growth. If you look at the latest stats from the International Chamber of Commerce, it's estimated that up to 90% of global merchandise trade is reliant on some form of trade finance. LIBOR has long been the default benchmark interest rate for trade finance, naturally with dollar LIBOR serving as the most widely used standard across the industry. It is the predominant currency in international trade. Trade finance products broadly reference LIBOR due to their transparency of pricing and certainty of interest costs. This is naturally critical, especially for those products offered at a discount. So your products like receivable finance, payable finance, but in fact, it's equally the case in all the loan type and discounted trade finance products. Transparent pricing and interest cost certainty in advance using these term rates is a key element to maintaining stability and minimizing disruption to trade flows. As a result of this, a forward-looking term rate is required to replace LIBOR to ensure that these products maintain the characteristics that differentiate them from other products, and of course to ensure minimal disruption to the capital flows that are facilitated by these products. It was also discussed the impact that clients would have, specifically those with multi-currency facilities and who are multi-banked. The clients could face several internal issues using a new risk-free rate, and thus overcomplicating further use of trade products. Thus, the need for other currencies to develop their term reference rates ahead of the LIBOR transition at the end of the year. So let's take a moment and look what has been happening in the market related to trade finance. The desirability of using forward-looking risk-free rates for trade finance has been recognized by industry bodies as well as the currency working groups. So including the Alternative Reference Rate Committee or ARC, the Working Group on the Sterling Risk-Free Rate Task Force, the IFTA, BAFT, ICC. Despite this, the development of forward-looking risk-free rates has lagged somewhat behind that of backward-looking risk-free rates. However, there has been some progress, specifically on some of the currencies. So on the 11th of January this year, the ICE Benchmark Administration Limited and Refinitiv began the live production of the forward-looking term SONIA, so in replacement of sterling LIBOR. And we've already seen some live trades happening. As it is not yet clear which provider becomes the market's preferred option, settling on an agreed rate may pose somewhat of a challenge. The Sterling Risk-Free Working Group has limited the use of term SONIA, but it is permitted for trade finance. The progress of the forward-looking term rate for US dollars has been slightly more delayed, but recent announcements from ARC that it has selected CME Group as the administrator that it plans to recommend for a forward-looking secure overnight rate, of course, once market indicators for the term rates are met, are encouraging. Whilst Euribor is fully reformed, there are still some concerns as to whether it will comply with the benchmark reform from a liquidity and representative basis. In other currencies, either no term rate is expected, for example, Swiss francs, or it still remains to be determined, like the Japanese yen. So the divergent timelines and approaches across the jurisdictions are a challenge that we're going to have to live with. And we will need to continue to monitor this development closely and plan for possible alternatives, should, for example, a SOFR forward-looking rate not be available before the end of the year. So what are some of the transition issues that clients need to think around? The impact and consideration have been discussed in detail by Annelies. And naturally, the impact is slightly different for the different products. So to avoid repeating, I'll just focus on some of the key elements. The first important point is around communication. The majority of banks will be communicating the cessation of LIBOR and advising that the bank has or will choose a successor rate or determine an alternative rate, together in either case with an adjustment spread, if any. In trade finance, I anticipate the detailed communication coming through, as Annelies and Perrine mentioned, in Q4, specifically as we watch the further developments in terms of term SOFR. Key at this stage is to be aware of the tenors that cease at the end of the year, and the fact that although certain tenors will remain in force until 2023, there is very specific guidelines from the regulators in respect of the use of this. Of course, these changes could introduce changes and an impact on the pricing of your credit facilities, so for both drawn and drawn amounts. And hence your current agreements with the bank, which Perrine had highlighted, will probably be amended to accommodate this. From a product impact, probably the key takeaway is that the impact is different to the different products. So for example, your trade finance, where there's more reliance on these forward-looking rates and alternative rates that are emerging, versus your debt products, where they will start transitioning into the in arrears risk-free rates. And you know, I think the key message from my perspective before I hand back to Joel is just to really encourage everybody to communicate with your bank if you are uncertain around how this could be impacting you, but equally to remain very close to the market developments, specifically those that are involved in trade finance, and as we wait for further announcements relating to term SONIA. Thanks, Joel.
Very much, Michelle and team. There's the disclaimer, so let's read that quickly. Okay, I think we're done, and then we can take that one down. And I think Michelle, if you also can stay on camera, we've got a bunch of questions coming in. Not all are aimed at all panelists and attendees, so if you please bring all your questions, but if you can, at the bottom in the chat area, it says two, and if you can change that to all panelists and attendees, then your fellow colleagues can also see if you have a similar question to them. So I am going to read these questions as literally as I can. I'm not going to paraphrase because it's a very technical topic, and I'm scared I'm going to butcher it. So I'm gonna go to the first question from Chivango. The question is, since endorsement is still outstanding, what is the current market practice? Or to be specific, how is Absa using alternative rates to get synthetic LIBORs in new loan and derivative contracts?
Thanks, Joel. I'm happy to take that one. Look, so I suppose endorsement comes in two forms. I think endorsement around overnight SOFR, is in place given the FCA announcement in March this year. That's obviously crystallized spread adjustments for 3-month LIBOR, 6-month LIBOR, etc. So with regards to overnight rates, and I wouldn't put this in the language of what is Absa's approach. I think we are being guided by what is the critical mass approach within the financial marketplace. So what we are thinking of with regards to overnight rates is following ISDA protocol, and as I mentioned, LMA is aligned to that thinking. So we think we're following critical mass, and that's the intention. And regulators have intended to use that approach to preserve the equitable adjustment in, the reformed or synthetic LIBOR rates that effectively will prevail post these timelines that have been articulated. I think endorsement is still outstanding on term SOFR in particular, because the derivative market is still so naive. But in some of the comments that I had in the slides, I didn't mention the SOFR First initiative, where a lot of regulators as well as market infrastructure bodies are saying that come the end of July, they'd like to see more and more market participants and derivative brokers and derivative market participants adopt SOFR first and foremost, which will then breathe a lot of life into derivative markets. And that, we believe, will lead to an environment where it affords regulatory and official sector bodies to endorse term SOFR as a potential alternative. I hope that was clear.
Thanks, Perrine, and Chivango. Thanks for that question, and please add on to it in the chat if you have a follow-up question, or let us know if you're happy with the answer. Tonderai also had a question around SOFR. So how are the banks capturing the SOFR credit adjustments in the legal contracts at the moment, and do you assume a fixed spread?
I'll take that one. Sorry, everyone, if I'm hogging the questions. Look, I think once again, I think it follows from the first response. Again, we're following ISDA here in terms of the credit spread adjustments that have been articulated. I think on the slides, we only mentioned the roughly 26 basis points, which applies for 3-month LIBOR. There's a range of others that apply to different tenor benchmarks, but that is our approach first and foremost. And I think the important thing for all the participants is our approach. Once again, we're trying to congregate behind critical mass thinking to ensure that transition can progress as seamlessly as possible.
So are there like meetings between the South African banks to create that critical mass thinking on a national level, or does it sort of just come out of the consensus? Does it exist by itself? I'm just curious.
Sure. And you're speaking about South Africa and JIBA, right, in this context?
Yeah, and we've got a question coming up about JIBA as well, but I'm curious to see who coordinates that, because maybe we should touch on Mohammed's question in that context, because he's asking around the Reserve Bank's thoughts. So he says, what's the SARB's thoughts and general market sentiment on South Africa moving away from JIBA, and do we think this could happen once the LIBOR transition has happened?
Okay, fantastic question. Look, I think let me break it up into 2 components. I think the foreign currency component, we are obviously a taker of what is happening globally. Our regulator is certainly asking questions of industry participants, and we think that will continue. Of course, they're advocating us to follow the trends that develop globally to make sure that South African banks and financial market participants also, prepare for this sizable change. $350 trillion worth of contracts transitioning is not a small task. So our regulator is certainly asking questions to make sure that South Africa protects its own interests and follows the trend lines that are emerging globally. The second point is, I'm going to speak at a very high level around what's happening in South Africa. The regulator has created a industry body called the Market Practitioners Group that is starting to formulate thinking around what happens in South Africa. What has landed already, which is in the public domain, and the SARB's website, will have a lot of this detail, is the SARB has already instituted measures to strengthen JIBA, but as an interim measure, and they've done things like commit banks to making markets in money market instruments in higher volumes, and they've put in place measures to enhance transparency so that all market participants understand how these rates are formulated, and that in large they are guided by underlying financial market activity. The SARB with industry engagement have also paved the way to what does our alternative benchmark environment look like, and what is our SOFR in the context of South Africa. And it is now in the process of working with the banking sector to harvest a lot of that information, so it, in due course, can publish what South Africa's alternative is. In terms of when South Africa potentially moves away from JIBA, that's still a very open-ended question. There's still a lot of work, but I think where we probably derive some benefit here is we have the opportunity to look mostly north and get a sense of what has worked, what has been less efficient or less optimal, to guide how we actually move our market forward and point and guide our market towards a safe transition within South Africa. But I think I'd like to conclude, I think this will happen in South Africa. The question is when. We think it's probably at least a few years away, given some of the ground that needs to be covered.
Thanks, Perrine. I do have a follow-up question from Chivango, also asked the first question. So, is the credit risk spread adjustment the only spread added to the overnight rates? And secondly, is the critical mass thinking alive to the fact that a client would have different credit spread adjustments from the banks? So I think that's the multi-banking component.
So maybe let me answer the last question first. I think that was the purpose around ISDA, was to specify a standard for all market participants to say these are the spread adjustments that you should apply. So if critical mass is moving in that direction, even though you're multi-banked, you should experience the same credit spread adjustment. If you don't, so I hope I've answered the second question. Just help me with the first question again. I just want to make sure I get it.
Yeah, is the credit risk spread adjustment the only spread added to the overnight rates?
Yes. So look, I think let's illustrate this in the form of a financial exposure. Let's say a client has a loan. It's currently priced at 3-month LIBOR plus 126. Sorry, let's make it 100. All that happens is you move into the synthetic world where you now have a 3-month compounded SOFR rate plus the original 100 credit spread plus the 26 basis point credit spread adjustment to effectively preserve equity. So that's that there are other credit spreads, but I think there's an existing credit spread on the loan that would still be in force once this transition concludes.
Thank you. And yeah, just to the attendees, please. This is we've got a couple minutes left, so please, if you do have questions, don't be shy and don't worry that it may be a silly question, because I think this is such a intricate and complicated topic that there's no such thing. But Michelle, I just wanted to ask you, maybe from a client's perspective in the trade finance space, because of how technical it is, I think there are businesses around that feel, hey, this is actually relevant for me, but I don't quite get it what it means. I'll just follow what my bank does and what my bank advises, and that's sort of it. Can you maybe just give some insight in what kind of decisions the trade finance businesses will potentially have to make themselves? Or can they leave everything to the bank, and is it just something that they sort of vaguely need to stay abreast of?
Thanks, that's a great question. I think the advice to all of those in the broader financial markets, but specifically trade finances, you need to understand the implication that this has for your business. Where you look at the multi-bank specifically on the cross-border side, you can have banks taking different approaches. I think what the industry bodies are trying to do is recommend a best practice, but of course they can't force market participants all to adopt the same approach. So you could see some banks coming out not using, for example, term SOFR and going into alternative reference rates. So I think the advice to all clients out there, whether you're an SME or a global corporate, understand how this impacts the approach that the different banks are going to take. There's always multiple parties involved in trade finance. So it's not just you and your bank, it's your counterparty and their bank and the approach that they're taking. So I would really recommend, I think all the banks are already communicating, at least in the trade finance space. The communication is very much around, LIBOR will cease at the end of the year. We're not yet sure what the alternative will be. We think it is going to be term SOFR that the majority will adopt, but we're still obviously waiting for the endorsement, as Perrine mentioned. So I don't think just leave it up to your banks. You don't want to get to the 31st of December and suddenly realize that there may be some implications, specifically where you are multi-banked. If you have questions, reach out to your banker, whichever banker that is. There's so much material available, lots of guidelines coming from the industry bodies on what you need to think around. But I would err on saying leave it all to the banks.
Well, yeah, exactly. And you mentioned SMEs, and I'm just putting myself in the shoes of an SME. I would probably think, okay, what's my risk? What can I do wrong here? And what you're basically saying is keep talking to your bank, follow their advice. Is that sort of the right conclusion?
I think for the smaller, to your point, the SMEs, the big debate around continuing to use a forward-looking rate was exactly to address the concerns that SMEs may not be sophisticated enough because of internal changes that would have to happen if you go into the compounded in arrears. So I think, depending on the sector that you're in, reach out to your bankers. They obviously have your best interest. They will be able to guide you. It's also worthwhile in industry forums to put forward, your thoughts on it and get others in the same industry as you to get their views on how they're dealing with it. But the banks are certainly going to provide a lot of guidance. I think to Perrin's point, equally as we're doing in the rest of the reference rates, we're trying to follow the guidance from the industry. So as the global industry forums start putting forward best practice, what are the items, we're taking that approach in order to try and minimize impact to all our clients, SMEs right up to GCs and banks.
Thanks. This may be a bit of a silly layman's question, but generally when things change, there's an opportunity. People, smart people see opportunities to make something out of it. Is that the case with this transition? Are there clever ways to play this where you actually come out better on the other side, or that you can make money? I mean, I don't know if there's anyone who wants to take that question.
Thanks for the hard question. Look, I think it's typically in financial market activity and the pricing of what is known as interest rate basis. So what does the basis between LIBOR and SOFR look like? And I think if you all recall that graphic that Annelies showed, the difference, it's highly correlated, but there is some deviation during different kind of market environments. So I think there will be those who express a view around what they think the spread should look like going forward that might want to take a speculatory view against basis in the financial markets. But I think it's exactly that. It's speculating. It's not a sure bet because it's uncertain as to what environment do we face over whatever period you're speculating in terms of the actual outcome of those spreads. So look, and I think that is a difficult thing to predict because we're moving from something that's credit sensitive to something that's risk-free. So the behavior is fundamentally different. But I think it's a good question. I think there will be those that will attempt, but that's more in the professional space, and it's probably more between banking counterparts, who actively participate and who actively bear that risk because they face off to the broader economy, and hence they'll have LIBOR, they'll have SOFR, and they need to mitigate that risk.
Yeah, I think that makes sense to me. Any other last tips for clients that may be useful, sort of having heard the questions? There's another question from Tonderai actually. Is the SOFR due to the daily compounding more volatile than the LIBOR?
No, in fact, I would say SOFR, because SOFR is actually, because it's risk-free, it's far more resilient. We've actually seen this during the height of COVID, when dollar financing conditions were initially quite tense. We actually saw LIBOR also move relatively higher versus SOFR. So I think if you do the stats, you'll see LIBOR is far more volatile, or relatively more volatile than SOFR is. That's absolutely what the history suggests. And we have no reason to believe that won't be the case going forward. Remember, SOFR is backed by US Treasuries, so there's a high degree of confidence in terms of that marketplace, whereas LIBOR is unsecured. And hence, any environment of stress or of difficult financing conditions will impact that market far more substantively.
Thank you very much. That's a great answer to Tonderai's question. Thanks to the panelists. It's very reassuring to have top experts around in our country who know what they're talking about when it comes to complicated topics. So really appreciate it. I think we're going to go to the end. I want to thank all the attendees for engaging, for showing up, and for learning together. Thanks, Perrin, Annelies, and Michelle, and Absa, obviously, for sharing your knowledge. If there are any further questions that come up Please let me know if you don't have the panelists' details. I'm happy to put you in touch with them as well. Obviously, also, if you feel your colleagues might benefit from the content, you'll be receiving the replay. So please spread that far and wide. I'm going to quickly share my screen again, and I don't have to explain to you that this is the webinar that you have just watched and participated in, but I am going to quickly show you our next webinars in the Finance and Other Network. So I have to click here quickly, yeah. So we've got the benchmarks for audit-ready financials coming up on the 14th of July. We've got the power of planning coming up on the 15th of July. And we've got finance automation promise realized coming up on the 22nd of July. So if you're not signed up for any of these, we forgive you, but you can head over to cfo.co.za/events, and you can make amends there and register for all of them if this is relevant and interesting to you. So once again, thanks to the panelists, thanks for everyone for joining, and wish you all a fantastic Thursday further.
Thank you.
Thank you.